and welcome to another episode of Financial Security Advice for Canadians. As always, I'm your host, Tom Johnson, a financial security advisor with Cascade Financial Group here in Winnipeg, Manitoba. It's that time of year again where everyone is filing their income tax returns. People are starting to get their tax refund checks in the mail or in the bank already, and that brings us to the time of year that people often have the most cash available to them, which brings up a really common question I get, and that is, should I put my money against my debt, or should I be saving or investing it? And that sounds, again, on the surface like something that should be a really simple, easy question, but when you dig under the surface, look under the hood, it's slightly more complicated than that. There are usually three factors that I want to consider when it comes to whether someone should pay off debt or invest any extra money that they have. The first and most important one being, is my debt manageable? If your debt is completely out of control, if you're finding yourself living paycheck to paycheck, month to month, you feel like you're not getting ahead because your debt is just eating up too much of your income, then absolutely you should be paying down your debt. No ifs, ands, or buts. Pay off either something that's extremely high interest like a credit card, or something that is a lower balance but a higher payment. That should free up some cash flow that you can then direct towards the next debt and the next debt and the next debt, and snowball your way out of our debt situation. If, on the other hand, your debt does seem manageable, you're getting by with your payments, it's not impeding your cash flow, you're able to save a little bit monthly or bi-weekly already, then choosing whether or not to invest the money or pay down debt is a great question to ask. That brings us to point number two. The question I want to know is, what is my better after-tax rate of return? What is the after-tax cost of my debt versus the after-tax rate of return I might get from an investment? The reason I say after tax is some debts are tax deductible. If you borrowed money from the province or the federal government to go to school, those student loans are often tax deductible. If you borrowed money for a business or to earn income, those loans are tax deductible, and so we have to adjust for the tax consequences. If your student loan's 5% interest rate, but you're in a 40% tax bracket, that deduction means that you're really only paying 3% a year. And if we compare that to a taxable investment, so something outside of a tax-free savings account or an RRSP, let's say a GIC. If you get 5% interest and you're in that 40% tax bracket, you're really only earning 3% net of tax. So we start to compare what our different rates of return are, because at the end of the day, paying off debt is the exact same as earning that percentage as a rate of return. So again, if it's a credit card, if it's something really high, 19-20%, getting a guaranteed 19-20% is a really great thing. Pay off that debt, hands down. But if we start talking more smaller numbers, more realistic numbers, and you're paying 3% interest, but your tax-free savings account has earned you 5% a year, then investing might be the better route to go. Lastly, question number three is, what is my need for flexibility? A lot of people are in the same mindset as our parents were back when interest rates were 19, 20, 25%, and paying down a mortgage is something that's kind of ingrained in us from a young age. But as a matter of fact, if you're paying 3% interest on your mortgage and you put your $2,000 tax return against it, that means that $2,000 is going to earn you 3% for the duration of your mortgage, but it's really hard to get access to it. You now have to refinance your mortgage to get that money back out if you need money in a pinch, whereas if you just put that money in a tax-free savings account and you're only earning a couple percent, you still at least have access to it. So that can help you if the car breaks down, if kids need braces, if something pops up and you have an expense. It's really easy to get it back out of a liquid investment, whereas if you've put it against debt, that money is gone and you better hope that we don't need to access it in the short term. So those are the three key points when it comes to paying down debt or investing. A really neat trick to do if it works out for you tax-wise and cash flow-wise is you could always put your money in something like an RRSP to earn you an additional tax refund, and then put that tax refund towards paying down your debt. Now you're kind of double dipping, killing two birds with one stone. Really neat financial planning idea for those who it makes sense. So hope you found that interesting today. As always, if you have questions, please check out our website, www.cascadefinancialgroup.com, and I will see you next time.